Ralph here, Zatara Transaction Advisors, zataratransactions.com. And I just wanted to go over our quick valuation tool, our VAC. So this gives us the ability to kind of go look at a business and within 30 minutes figure out kind of in general what the thing is likely to sell for. Um, and then once we know kind of what the business is most, probably worth, a little bit of a value range. We can ask the owner, or we can find out if that works for the seller, right? And if he's willing to sell it for a reasonable amount. So it kind of allows us to quickly, do a sanity check on whether or not the owner is reasonable in what he wants for his business. Right. So I'll quickly go over what's all involved in this. So you have, the company, the industry that makes, and then why the owner wants to sell, if they do want to sell, or if they've got another plan. So maybe they're looking at an unsolicited offer. So somebody's put an offer on their business. They want to know, well, is that reasonable? Like they offered me $2 million. Well, I don't know. Is the business worth $2 million? Who knows? Right? Kind of when they want to exit, how much energy they have to put into prepping the business for exit, all these things. And then you got your general risk questions. So a business is going to sell for, you can think of it, what is it? Warren Buffett talks about the present value of future cash flows. So all the future cash flows combined brought to the present value, and that's what the business is worth. He looks at it, he uses simple methods to try to understand what a business is worth. For example, when he looked at Coca-Cola, he said, okay, if Coca-Cola sells however many billion servings a year of Coke, well, if Coke is worth 2 cents more than Joe's soda or whatever it was, or 1 cent more than Joe's soda per can or per serving, then this company's undervalued and I'm going to buy it. Right? That's how he valued Coca-Cola. Anyways, so you're basically looking at the size of the business, the efficiency of the business, and the risk of the business, and that's how we quickly analyze companies. This is before we do a full valuation. This is like our quick 30-minute sanity check, right? So you got a bunch of risk questions, right? So this one's got a couple risk issues. Business is steadily declining, so it's kind of the business is shrinking, I guess. Doesn't have a general manager, so the owner's probably burnt out. Yeah, he's working 30 to 50 hours in the business. The lease is kind of, who knows where the lease is at. It's under 5 years. They're just using Excel sheets. And then they got a lawsuit and a couple other things. So pretty decent sized company though, 15 million in revenue, 1.2 million in pre-tax profit. EBITDA, there's no discretionary spending, I guess, in this one, and they must be paying market rate for rent. They don't own the real estate. I'm going to say this is a Canadian company. So, anyways, they got $1.265 million worth of EBITDA. The multiples. So using the industry multiples, I said this plumbing company. I didn't do this VAC. This was just a random one I pulled up. A random company, I guess. Anyways, so yeah, you look at the multiple, you look at the risk, you look at the earnings, you multiply those together, and that's basically going to give you what the business is going to sell for. So in this case, business is worth about 4.427 million. Okay, the size. So how do you increase the value of this business, right? We talked about it. We got size multiplied by efficiency multiplied by risk is kind of the value of the company, I guess you could call it. So okay, if you increase the size of the business, assuming everything else remains the same, so your EBITDA is 8.4%. Now it's $18 million worth of revenue, 8.4%. So your Your EBITDA is going to increase. Like originally it was, what was it? They got 1.265 million in EBITDA, increased by 20%, 20% more EBITDA. So 1.514 or 1.518, sorry, million in EBITDA. So it's going to increase the value of the company by around 890 grand, 885,000. So if you increase the size of the company by 20%, assuming everything else stays equal, you're going to generate about $885,000 worth of enterprise value. Okay, what if you were to make it 5% more efficient? So right now you look at the efficiency, it's an 8.4%. That's how efficient the company is. So for every dollar that they do in revenue, they keep 8.4 cents, right? That's like the profit to the owners, the free cash to the owners. Okay, so if you were to get 5% more efficient, so instead of you taking 8.4 cents, you got 13.4 cents. That's going to generate $2.625 million worth of value. So if you just increase the efficiency even by 1%, 3%, it's the lowest we got here. 3% is going to generate more enterprise value than you growing it by 20%. Obviously, you got to keep growing the thing in order for it to have the right growth trajectory for the next owner. But if you increase the efficiency, you'll get way more. You'll almost, you're going to add, I don't know. There you go. You're going to add almost 60% more sale price to your company when you go to sell it. All right, now let's look at risk. Okay, so if you were to get a 40% better multiple, so instead of 3.5, now we're getting 4.9 times EBITDA, right? That's going to increase the value of the company by $1.771 million. So it's going to increase the value by 40%. So if you combined all those things, if you were to, okay, let's grow this sucker, let's make it more efficient, and then let's de-risk it for the next guys, you could triple the value of this company. You'd get 167% more money. So instead of 100%, you get 267% more, or 267% of the current value for selling it, right? Okay, so let's start looking at this. So here are all the risk questions, right? So you got to grow this thing. So if you were to turn this thing around, start growing it, bring in a general manager, decrease the amount you, the owner, so actually you step away, bring in an owner to work in the business, you do the other stuff. So you're only spending 20 hours in the business, and the rest of the time you're bringing in a general manager, fixing this. So between, no, it's going to stay the same. Go and get that lease renewed, get over 10 years or over 8 years. Let's do 10 years. So you're going to have, a 5-year lease with a 5-year renewal, and you already got that lined up. And you're going to change it. So you're going to start managing it as a cloud-based enterprise, ERP, or a customized CRM. Let's do a cloud-based ERP. And then your customers, now you're going to start looking for some recurring revenue, and you're going to get rid of this lawsuit. So over the next year, you're going to do all these things to decrease the risk of the business. So before we were 3.5, now we're 4.35. And then we'll leave this earnings stuff the same. I just want to show you though, if we go through a value enhancement process, we can generate $1 million in enterprise value when you go to sell it. So if we work together for a year or 2 years to get the company ready to sell, we can generate over $1 million of value for you. So that's a pretty damn profitable year. Plus, you also get to keep your EBITDA that you are already generating. Which was 1.265, but we're turning this sucker around. We're really focused on you working less in the business, getting somebody else to run it, right? You're no longer the one running it. You have a professional manager who's now running it. And you're just going to focus on, okay, how am I going to drive value in my company? Because when I go to sell, I want to maximize the amount of money that comes to me, right? And then we have our last little step is just a wealth gap calculator. So this is owners often ask, do I have enough to retire? And the answer is, I don't know. But let's do the math. And then you tell me whether you have enough to retire, right? So right now you got your current scenario. So your annual income would be, what you're taking out of the business, your wages, whatever personal expenses you got running through the business, and then other passive income. So if you got, there you go, rental property, investment portfolio, dividends, other businesses, right? So this owner in particular, this guy, he had 550 grand a year that he was kind of taking home, $500,000 taken home to the wife and the kids. And he had about $1.5 million kind of set aside, and he's got 75 grand in, let's call it line of credit debt. Okay, so what does he want for retirement income? This guy in particular, he wanted 575 grand, and he's willing to spend the next 5 years making the business better. Or he didn't he didn't sorry, he wanted to be fully retired within 5 years. So he was willing to work in the business for a couple years for the next owner or whatever. He wasn't retiring tomorrow. He was retiring in 5 years. Okay, so let's go through the wealth gap calculation. So he needs 475 grand, right? Because he's got 100 grand here, and his portfolio, he's going to get a 7.5% return. So his required investment portfolio size was 6.333 million, and then the gap to fully fund the portfolio, which is the net assets minus the total required size of investment portfolio, was 4.758333 million, right? Okay, so this guy owns 100% of the business. The business wasn't growing 3%, but let's say, it's growing 5%. There's no debt in the business. Net proceeds required after debt consideration. So he needs this much money, right? Estimated fees and taxes as a percent of the sale. This is low. It'd probably be closer to 15%. So target business revenue. This tells us how big the company has to be in order to get that price, right? And his target sale price is 5.472 million. Okay, so he could sell it today. This is based on all the changes we made over here, right? He could sell it today if he wanted to. And this is going to be data from the VAC tool. So this is data that we're pulling from here, right? Okay, so current years to exit. Well, you could sell it today. If we want, we could do some exit planning, and we could get you a higher multiple, everything else, and your years to exit, because we grow it a bunch, blah, blah, blah. Now you could exit it. This is from here. This is the potential value here. So if we were to grow it and everything else, blah, 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 you would have been able to sell it years ago. Obviously, this formula kind of breaks whenever you're more than adequately financed. You could have retired a long time ago, right? Anyways, then it calculates it all out. Okay, so your current years to exit. If we did the whole value enhancement thing. So if we go through this process of increasing the size of the company, getting more to the bottom line, so basically making the company more efficient, right? And then de-risking the business so the next guy's willing to pay you more. That's kind of the situation here. So there you go. That's our VAC tool. Again, it's a quick method, quick tool we have to quickly analyze what a company's worth today. Uh, if you put some work into it, what it could be worth, and then whether or not the owner is reasonable in what they expect to sell their company for. Because a lot of times um, owners have an idea of what the company's worth, but it's not grounded in reality, right? They've just picked a number out of the sky, and that's what I want to sell it for, and that's fine. Maybe it's not worth that today, but if we put some work in and do everything else, maybe we can get it to be worth that, right? So I dealt with the guy last week. I think the company's worth 6 million. We went through this whole thing. It's worth closer to 5.2. But we looked at it and we said, okay, if we grew this, made it more efficient, increased the multiple, it had some risk issues. We could have also probably doubled the size of it just because he had the infrastructure there. So it was a sales and marketing problem. So probably a sales and marketing team, adding them to the whole mix. But yeah, he with his current infrastructure right now, because of how it works, right? You've got a relatively high fixed cost and then a relatively low variable cost and a pretty high margin. And so you grow the revenue of the business. Obviously, more of that is going to hit the bottom line. So instead of a 40% EBITDA margin that you have now, it might go up to 50 or 60%, and you're also doing twice as much revenue. And so your EBITDA multiplies by 2.5, 3 times, right? So, of course, the business is going to be worth that EBITDA number multiplied by the risk, or multiplied by. That's why everybody always talks about the simple. What's the EBITDA multiple, right? Well, you can look at a business and you can tell what the EBITDA multiple is, but why is that EBITDA multiple what it is? Anyways, and that has a lot to do with the risk of the business. So anyway, the long story short, I met with the guy and basically we found out, okay, if we did a bunch of work together over the next couple of years, yeah, I could sell it for 15 million bucks. And he said, you give me 15 million bucks, I'd be happy to walk away. It's like, all right, well, let's work together and let's get it done. So yeah, that's our quick valuation tool, Raph, Zatara Transactions, Zatara Transaction Advisors, here in Saskatoon. God bless you. Take care. Bye now.